Welcome back to episode number 2 of the Plena Wealth Advisors podcast. Again, this week joining me, we've got Craig White up in our Kelowna office and Clark Linton around the corner here in Vancouver. Today we've got some exciting topics. I think everyone's going to be a little bit interested in hearing what we have to say about the Vancouver housing market and I guess the Canadian housing market more broadly and how that impacts all of our wealth planning decisions. We'll also touch on some tax topics which we feel are timely and tie things up with a little bit of a discussion on the state of the economy and some recent inflation numbers that have been coming in. Without further ado, I think one of the things that we've all been paying some attention to anyways with the rumblings and concerns over the recession or economic slowdown that's at our doorstep. One of the big news items we saw a couple weeks ago now was a local developer, Coromandel is the name of it, who filed for creditor protection here in Vancouver. And this was not a familiar name to myself, or I don't think anyone else on our team, but they did have about $1 billion of real estate holdings across Vancouver. And they had $700 million of debt against those $1 billion of real estate and could no longer afford to pay the interest on that debt. So kind of the first real crack we've seen here in Vancouver real estate amidst an ongoing bull market, really seemingly for the last 20 or 30 years. I can't recall anything of this magnitude coming across recently. Kind of brings up that old saying that if you owe the bank $1 million, it's your problem. If you owe the bank $10 million, it's their problem. Well, in this case, $700 million is going to be a tough pill to swallow for someone. I think the list of creditors is relatively unknown from what I saw, but curious, Craig or Clark. Is this a systemic problem we're facing in the Canadian real estate market, or is this just a poorly managed balance sheet that is more of a one-off?
I think it's likely a bit of both. If you look at this company, I think as you mentioned, we didn't really know a lot about them, but I think it's typical where you've got a company. In this case, it's an offshore developer, I believe, that over the last number of years probably paid a little bit too much for the real estate they acquired. As values went up, they're in development phase or permitting phase, values went up, they re-leveraged properties, and now they're facing the perfect storm, slowdown in the real estate market, having difficulties selling properties. They're also blaming the slow permitting process in Vancouver. But bottom line is interest rates have gone up and their cost of capital has gone up. And if you look at what's happened to the prime rate, going from the mid 2s up to 670, the bank prime rate, that's an increase of about 270% in the cost of borrowing. And that's going to affect, any company that is highly leveraged, mismanaged, whatever it might be, it's going to affect them. So I think your point about a poorly managed balance sheet or company is correct. But they're not alone. The real estate market in Vancouver and Canada in general is not going to be immune to what we've seen, primarily this rise in interest rates. Some of the things that I don't think have reached enough headlines, Brookfield, for example, who manages a bunch of investment limited partnerships. I'm not sure if you guys saw the headline, but they recently defaulted on 2 properties in LA. Mm-hmm. Brookfield, one of the strongest companies in Canada in our view, but even them, facing difficulties. In this case, again, the rise in the cost of borrowing. I think COVID was partly to blame for that. The vacancy rate in the central business district for commercial properties is running about 23%. So you match that, a difficulty to lease, properties that are being developed with a significant rise in interest rates. This is not a one-off thing, or it's not likely to be a one-off thing. The other thing is just residential real estate. If you're a homeowner, again, seeing that magnitude of interest rate increase. I think the Canadian government in hindsight was smart to make qualification more difficult by saying, well, here's the interest rate today, but you've got to qualify on whatever it was, 3% higher. And that's all come home to roost, is that, rates have moved higher. So I think there's a lot of people that that will be fine, as a result of going through that tougher qualification process. But there's still going to be people that default on their mortgage. This is a difficult environment where your mortgage payments or your interest rates have gone up that significantly. And I think the final part of that is, what this has also done is it's taken that next level of buyers out. With interest rates where they're at, real estate prices still elevated. Those first-time home buyers are going to be absent from the market for a while. Even speculators or investors that were taking advantage of a low cost of borrowing and rapidly increasing prices of real estate, generally they're absent from the market right now. So you're likely to see that show up in prices where you have a lot of supply coming out of the market and these buyers taken out of the market.
Yeah, I think with the developer like that, I think where they're building in expectations of continued appreciation of the property, and aren't really cognizant of the impact of higher interest rates and the effect on their ability to cash flow their properties. I mean, it seems so obvious in hindsight, but for the last 10, 15 years really here in Vancouver, I mean, that's been the winning trade, right? How much leverage can you take? How much equity can you take out of these properties as you're going along and developing them? And the more leverage, the more equity you can reinvest, subtract and reinvest, the better off you're going to be as a developer. So, that's been the winning trade, but it works until it doesn't. I think this is kind of the first instance we've seen of a developer getting, really caught offside there. I think the maybe somewhat concerning piece of this is it didn't even really take a decline in property values to make this all happen, right? This was only on the interest rate side of things. We haven't even seen, broadly speaking, the Canadian real estate market index is down from its highs, but in terms of significant decreases in price, like that hasn't even happened yet. Right. So what happens when all of a sudden your interest cost goes up and all of a sudden, the condos you were planning on selling for X dollars, you're now selling for X less, 10 or 15 or 20%. I think that's when we could face some more significant challenges. But Craig, what do you think? Is this something that the average client or homeowner has to be worried about that isn't involved in kind of, real estate development?
Well, a couple of things. I think, guys, a lot of points are extremely valuable, what you just pointed out there. I think everybody's well aware of what's happened with interest rates. I think a couple of things that I'll take away, and Clark, a few words that you mentioned there is cracks and higher rates. And really, you're starting to see these initial stages of cracks in real estate. And that's a reflection of cost of capital. If you back that out, that's a larger reflection of what's transpired over the last couple of years when you've had a revaluation of asset classes. And we talked about that in our first podcast, how you had a revaluation of equity and fixed income prices. And now you're starting to see that filter into real estate. And that's built off of years and years of a massive amount of stimulus and liquidity that was injected into the system. And now you've had a massive vacuum that is essentially sucking that back out. So are we surprised? Probably not, to see this revaluation in real estate. Again, you got interest rates, as Clark says, that are north of 6% right now. A borrowing rate on a 5-year variable is 5.6, which relative to where we were, as Clark mentioned, 18, 24 months ago, that's doubled, if not tripled in a lot of cases. So yeah, am I surprised to see it? Not really. For the average homeowner out there, I don't see it as a big concern. I don't think a lot of people have a anticipation of selling their principal residence anytime soon. That being said, those who are highly levered, it's probably a rude awakening, and you're seeing these cracks emerge with a commercial developer such as this. So I think what we need to look at and be cognizant of going forward is what percentage of mortgages on the personal side are variable relative to fixed over the last number of years. And some of the stats that I've read more recently, you've almost got about a 50-50 split over the last year and a half of variable relative to fixed. Those who are going to be resetting within the next 12 to 24 months, again, they're probably in for a little bit more of a challenging period than those who have locked in at anything lower than where we are today. And that remains to be seen. So high leverage, this is when people get caught, when rates spiked at the quickest pace in 40 years. So it's early stages.
Yeah,
I think one thing to add here. Go ahead, Jay.
No, go ahead, Clark.
One thing to add here, I think, is kind of the trickle down effect. As portfolio managers, when we look at the broader economy and we look at companies we invest in, that I think the mortgage market in Canada is relatively well protected. High leverage mortgages are insured by CMHC or other insurers. So I think the effect of defaults, on the banks or things, we don't anticipate like a credit crisis like they saw with the U.S. real estate meltdown in 2008, 2009. But what happens when, a lot of these variable rate mortgages, a lot of them actually, the payments don't go up as interest rates go up. They stay static, but less of your money is going to pay off the mortgage and more is going into interest. However, a lot of these variable rate mortgages are now hitting what's referred to as their trigger rate, which is the rate at which your current mortgage payment doesn't cover the interest. So the mortgage rate actually the mortgage payment actually has to start to go up. And Craig, you mentioned, what happens when a lot of these 3 or 5 year fixed mortgages mature over the next couple of years, and people's payments are going to be, 30, 40, 50% more. So I think that the bigger thing to be concerned about is maybe the effect in the economy where, all of a sudden your household has $1,000 less in disposable cash flow or income because it's going to service your debt. Or as prices were elevating, people, taking home equity lines or line of credits on their home to buy a second vacation home, to go on holidays, to buy a new car. If that money's not there, as a result of that money going to a higher mortgage payment, that has an effect on the economy. And I think recently, it was last week, Home Depot, which relies a lot on, people renovating their home, usually on a home equity line, issued a profit warning just about what they see going forward. And I think there's the likelihood that we see a little bit more of that going forward.
Well, I think that's exactly what markets have been telegraphing for the better part of a year, is an economic slowdown. The equity markets have a tendency to forecast 6 to 9 months out. And again, you look at when it peaked, that was essentially 9 to 12 months ago. So it's been forecasted. I think for me, the big concern as well is Canadian debt levels. If you look at Canadian gross or debt to gross income, where we are right now, we're at about 180%. We've never been higher. So there's not a lot of dry powder out there in a rising interest rate environment. Pretty safe to say that we're going to go into a slower economic period. Bottom line.
Yeah. And I don't think that's something we need to be, terrified about. I mean, we've seen the upswing with the, the COVID boom, and people bought all the toys and, outfitted their home office and, did what they needed to do, spending that money. And, now we're going to see the other side of that, where we're going to see a period of slower growth. And in Canada, like you said, Craig, it's probably going to be a little bit more pronounced because of our debt levels. But you know what, it's kind of consistent with the messaging that we've kind of been giving to clients and, direct meetings or through our, quarterly conversations is, you have to manage your own balance sheet. You have to be aware of how much debt you're taking on relative to your household income. And, at the end of the day, living within your means. And if you're doing that, you should be able to, withstand a higher interest rate on the debt that you do carry, if you do have some, and you should be planning for, all of the potential outcomes. So, without a doubt, we're in all likelihood going to see a slowdown, but in Canada, I think the housing market surprisingly has proved resilient so far. A million new immigrants a year will certainly, help buoy the housing market to some degree. But I think that's going to be a big topic of conversation as we move through the rest of this year.
Yeah. 2 last points I'll make on that is, I think it's fair to say that, all pockets of Canadian real estate, it's not homogenous. I don't think you're going to see, one or, all sectors come down, whether it's commercial, retail, residential. You're probably going to see some strength in other areas that have been depressed, maybe areas like Calgary, where real estate, for a number of years wasn't as strong, whereas maybe pockets like Vancouver, Toronto, Victoria, even here in the Okanagan, maybe under a little bit more duress. So again, it's gonna be very interesting to see how that develops. The second point is with what Clark mentioned there on banks. For us as portfolio managers, we're not concerned anywhere near the extent as in 2008, 2009. Financial institutions, banks across the board are well more capitalized now than they were 15, 16 years ago. And ironically, we're going right into Canadian bank earnings season. I think it kicks off tomorrow with CIBC. And it'd be very interesting to see what their forward guidance is. And what they do is they put aside money, quote unquote, as what's called loan loss provisions in the event of defaults. But very interesting to see what banks who have their boots on the ground, in particular on residential mortgages, what they're starting to see. We'll be right on top of that over the next couple of weeks.
Yeah, it should be interesting for sure. So we'll keep an eye on that. Now, switching over to everyone's favorite topic of taxes. A few kind of recent changes in proposed tax policy have caught our attention, and worth kind of, I think, just kind of thinking about how these may impact the global economy, may impact kind of clients' outlook towards the Canadian kind of marketplace. But basically, Trudeau and Chrysler Freeland have proposed a 2% stock buyback tax on any company that's buying back stock, which is proposed to take effect January 1st, 2024, so just less than a year from now. The tax is expected to raise about $420 million a year. So not an overly meaningful amount of money. I think it's much more in the spirit of encouraging companies to reinvest in their own businesses instead of simply trying to increase their stock value, which is a lot of what the CEO and management's compensation is tied to. There's also been a windfall profit tax proposal. A lot of these taxes are really consistent with the trend that we're certainly seeing, that we're certainly relaying to clients is expect higher taxes, expect higher property taxes. Even here in Vancouver, they just proposed a significant increase in property taxes, and that's got I think like a 10-year expected increase. So it increases like almost 10% the first year and then slightly less, but on an increasing rate every single year. So just I think backing up a half step is does this change our view of kind of the corporate landscape in Canada here from an investments perspective? Craig, Clark, what do you think? Is this what does this take our view of Canada's corporate climate to?
Well, this is probably a bit of a debatable topic because it's a theme that we've heard now for the last number of years is this redistribution of capital, right? And it essentially transferring funds or assets from those who have been successful, whether it's on the personal or on the corporate side, to close in this wealth divide that, I think we can all agree has been pretty
widening.
What's that? Sorry?
It's been widening.
It's been widening over the past number of decades. And, you're more recently seeing that on companies such as Canadian financials. You're seeing that out of the US and the UK with some of these energy companies that after a number of years of a very challenging environment for them, they're reeling in excessive profits. Now, as capitalists, being in the business that we're in, I try to wrap my head around the word what excessive profits mean. But this is a theme that, again, we continue to hear about when companies that remain successful and are, I guess, sheltering or sitting on large portions of capital, governments are trying to provoke them to do stuff with it. And this is what you're starting to see. You saw that in 2021. I believe there was a 15% windfall tax on Canadian banks that had anything over $1 billion of profits. And it was a one-time windfall tax, which is generally what a windfall tax is. But it's a theme that I don't think is going to go away anytime soon as you see some of these large mega cap companies, Amazons, Googles, the banks that fall into it who almost operate in a monopolistic type area, that there's targets on them.
Yeah. And I guess you would say, like, when we were at the early days of COVID, the government was, playing a huge role in supporting the economy. And they did distribute a lot of money out to, the people that needed it and the corporations that needed to keep employment, where it was. They probably stayed in that game a little bit too long. And, in a sense, they're asking for their money back now. And a lot of these corporations did benefit tremendously from that. So, it's not hard to make the case that there maybe is a little bit of a debt owed to the Canadian government. I think where traditional economists, capitalists, whatever you want to call yourself, see the biggest problem with this is effectively you're taking money out of the system that would otherwise be put to good use, that would be recycled into, corporate growth, into, economic growth, and putting it in the hands of the government. And I think most people are fairly, on the same page when it comes to the most efficient users of capital being the private sector and not, within the hands of the government. So it is a challenging issue, I think, to really square away, particularly in this era of, high involvement in the government and higher taxes, more or less across the board. Clark, curious on your thoughts. I will recognize that you did pat the government on the back for their stress tests on the mortgage front just a minute ago. So what do you think about recent tax proposals?
I wasn't actually complimenting the government on much. I was just saying it might have been in hindsight, a smart rule. I guess that's a compliment. But now you're putting me in the hot seat of criticizing the Liberal government, which is not, it's not too difficult for me to do. And I think there's really 2 points here. And, you had mentioned that they gave, these large companies a lot of money during COVID. Now they want some of it back. I think that was the biggest mistake, is that, there's a difference between giving and loaning. So a lot of this was subsidies provided during COVID, and now they want it back. I mean, they should have called it what it was back at the time. If you're provided with a subsidy, you're going to take it. If you're lent money, you're given the opportunity to borrow money from the government in a time of need like COVID. That encourages a thought process. Do we need this money or do we not? But it also, 3 years later, when you're asked for that money back in the form of a hidden tax, it's, like you said, it's asking for money back that they gave. So I think in hindsight, one of the bigger issues, it was a symptom of the problem, or this is a symptom of the problem back 3 years ago, was just giving too much money away too easy in the form of subsidies. And again, they should have called it what it was if they intended to take it back. The other issue I have, and this is just maybe the capitalist in me, and is who they're taking it from. They've got no issue at all going back to, quote, the wealthy or large corporations, because they have the deep pockets to do it. Look at the problems with the wage benefit program, where employees that couldn't work could apply for a wage benefit. And, as we've all read over the last few years, there was a ton of fraud involved with that program, with people applying twice or under different names or whatever it might be. Recently, they discovered, I think it was the Auditor General, discovered that there's just over 15 billion in misallocated funds with this wage benefit program. But when brought to the attention of CRA, the CRA says, hey, it's not worth going after these people to collect it.
It's too much work.
Look at the difference between, $15.5 billion, in a lot of cases, outright fraud by individuals, relative to the amount that they were capturing with this tax. And it's, for the Liberal government, it's very politically acceptable to go after, again, quote, the wealthy or large corporations. It's a very easy political comment. Going back after that 15.5 million is a lot more difficult. That's generally the problems that I have with it.
Well, it goes along the debate of who has better use of the funds, those who create the wealth or those who confiscate it, right? And you look at, the financial institution, you look at some of these large mega caps, again, with their targets on their back, they have three uses of source with their capital. They have share buybacks, which is a big talking point right now. They pay out on dividends, and if not, increased dividends. And the other use is capital expenditures, whether it's organically or they're inorganically go out and acquire another business. And right now, it's the government is trying to mobilize the money that's sitting there as retained earnings, saying, what are you going to do with it? And, if you start looking at taxing buybacks, for example, what is the impact on that for, the exposure that pension plans, endowments, the retail public has that are invested in these same very companies that they expect and they receive dividends through. At the end of the day, it's the movement of capital. And if Royal Bank's going to decide to buy shares back from the public, well, that takes money from the investor's hand. And what generally does that investor do? He redeploys that in another asset, or he consumes something with it. So it's not as if the capital disappears. It's, again, moving within the system. And that's where the government's targeting.
Yeah, and I think that's the big point is that you want to be friendly to capital at the end of the day to make sure that you've got a vibrant economy. And, you think about it at an extreme where, a country like France started their billionaire tax. I think it was like 10 years ago. And very quickly, something like 40 of the richest people in France relocated outside of France to avoid the tax, causing the French government to pretty quickly, I think within 3 or 4 years, actually retract the tax, try to draw those wealthy people back so that they could then grow their tax base because tax revenue actually declined. So you always have to be careful with these taxes in terms of, despite having, potentially good motive, the net effect can sometimes be, quite the opposite. The unintended consequences can be, quite significant. So always interesting to see what the government has in store. But I think for most of our clients, again, the messaging is always expect higher taxes, expect rates to only go one direction, and try to plan around that as best as we can. So.
And let's be fair. Sorry, just to interject there. Let's be fair. I think when you listen to the wealthy and the super wealthy, no one's complaining about paying their fair share of taxes. It's the approach on how they get to taxing the wealthy. If you look at this rhetoric over the last number of years of taxing unrealized capital gains, some of these large entrepreneurs, I'm not going to mention any names, that are sitting on, 500 million, billion, $50 billion of stock that, on paper, they don't generate a lot of income personally, but their net worth is extremely large. They're some of the wealthiest people in the world. How do you go about taxing unrealized gains? And how do you track that going forward, saying, okay, this year, Mr. Smith, you had, $100 billion sitting in Amazon stock, and we're going to swipe 2-3% off of that, off of a nominal number on December 31st of any given year. What happens the following year if there's a capital loss or unrealized capital loss? Do you give back money that was taxed in the previous year? Again, I think the idea the wealthy can wrap their head around, that they want to pay their fair share, but arriving at a fair and equitable approach is far more challenging.
I'd agree with that. Now, Jay, I'll come back to something you said that I'll be somewhat critical of. You mentioned with the stock buyback, 2% tax on the stock buyback, that the criticism, I guess, is that encourages CEOs to do buybacks to inflate their stock price. I'd argue against that. Really, I think I would put my faith in the CEOs of companies like Royal Bank or TELUS or Bank of Nova Scotia or whatever it might be, rather than the government. I think that they're incented by just generally making their businesses more profitable. And as a result, their share price will increase if they are. Dictating to them or, making it unequal in their incentive to, should you buy back stock or should you acquire a company? I think if I was the CEO of any of those companies, I would be looking at, around the table per se and saying, today, is my stock a better investment than that company that we're looking to acquire? If my stock's declined 40% because we've gone through a difficult environment, but the company that I'm targeting acquiring has become more expensive, I would incent that CEO of that company to make that proper decision. I think that's really where their incentive is, not necessarily in the short run to get their stock price up. And I think that's really the difficulty that I have with this, is you're taking, a capitalist type decision-making process for heads of companies and having more influence by government in how they make those decisions. And I simply think it's wrong. It doesn't mean, though, that, going back to governments having to recapture more tax, that's a trend we've seen for years, and it's a trend we're going to continue. And they will have to get it from those that have it, and that's what they're going to do. Yeah. But again, going through this kind of making a disincentive to make good corporate investment decisions, I simply think it's wrong.
Well, disincentive, I think, is the right word. Jay, maybe you can speak to this. Do you think this, this approach and more taxation on, big successful companies, does that make the Canadian landscape less competitive?
Yeah, I mean, absolutely it does. I mean, the only, Trudeau timed this buyback announcement, dovetailing off of Biden's announcement that they were enacting similar policies. So, they took a lot of cover in doing it then. It's also just been kind of one of the proposed, tax schemes because, of the growing, inequality gap and the, wage gap that we've seen kind of persist. So I think, it's one of these things. It's like we're in a society where there's some level of, government involvement in any business that we're running. What the right level is ultimately, is up to the politicians to decide. And, like we've seen in the past, you kind of go too far and you're going to push your economy into a position where you're discouraging growth, you're discouraging investment, you're potentially pushing, corporations to reincorporate in different jurisdictions. I mean, the US is the easiest, most obvious example for Canadian companies. We always just have to be careful, when you're setting policy with any tax. And I think that's something that, we need to kind of continue to keep an eye out for. For now, I mean, Canada does have, obviously, we have a bias towards Canada. There's companies that we view more or less favorably than each other. But when it comes to, at extremes, or when you kind of, push policies, beyond where the market deems them to be acceptable, I think that's when you start to see, those unintended consequences, rise to the surface. So,
or as the saying goes, there's nothing more permanent than a temporary government program.
Yeah,
that's the fear probably amongst some CEOs that feel like they have a target on their back.
Yeah.
Well, I think that's the issue with taxation is that, you look at what was a windfall tax. I mean, when's the last time you saw a tax repealed? I mean, it's very rare. Is that what will be a temporary tax will likely become a permanent tax. I think, what I've told clients for the last 13 or 14 years since the financial crisis is as government debt has ballooned and just become a bigger and bigger issue. I mean, how many times have you guys been asked by clients that, what's going to happen when the government defaults? What's the end game to all this government debt? And, I've always told people that don't worry about the government debt and its effect, the actual effect of government debt on the market or the economy. You've got to look at what how government gets out of debt and the ramifications of those. And what I would say is there's three ways that government gets out of debt. They inflate their way out of debt, or they benefit from inflation. And that's what we're seeing now. If you have 2 years of 7, 8, 10% inflation, you're paying that debt off with richer dollars, and it costs you less to pay off that debt. The second way is decreased government spending. That's very unlikely. We don't see that. In effect, we actually see increased government spending. So the third way is tax. And I think that's the ramification of this government debt. It's going to be the most likely way that we reduce government debt over time. And it's here to stay. It's a trend. And kind of repeating what we've all said, it's not politically correct to go after, those, that largest percentage in the middle ground, but go after those with the wealth, whether it's large corporations or wealthy individuals. And it has been income tax for years. It's been sales tax for a number of years. I think what we now have to see is it's going to be a tax on wealth, an extra tax on profits like these windfall taxes, et cetera. And I think, the advice that I'd give our clients, and I continue to give them this advice, is one of the biggest things we have to manage around in their own financial circumstances is taxation.
Yeah.
Ditto. Yeah.
Great. So kind of tying things up here, our last little subject, the big question everyone continues to kind of ask themselves: Are we seeing a soft landing in the economy? Are we seeing a hard landing, or as many people started to believe in January with the nice little lift in the market, are we actually seeing an aborted landing and a return to full scale growth and with nothing to worry about? So I think one of the things that was interesting that just recently came out, as you mentioned, Clark, Home Depot came out with their earnings actually just earlier this week. And one of the things that they noted was they saw a decrease in revenue, and they blamed that on the decline in lumber pricing. So lumber being a main commonly traded commodity, with commodities being some of the best indicators of future inflation, lumber pricing has already come down considerably. At the same time, Home Depot is expecting to claim $1 billion in expenses due to increased wages for this year ahead. So you're seeing kind of this juncture where you're seeing dropping commodity prices leading to lower revenue on the same relative number of sales, and then higher costs because of higher wages expected because of the recent inflation. So a really interesting kind of new chapter of this inflationary period here. Clark, what's your read on inflation over the next 6 months? Have we truly seen the end of peak inflation, or where do we go from here?
I think for those that watched our podcast number 1, I think we gave a really good view on inflation, or I did, and actually made the prediction that by the end of this year, I think we'll be back into the central bank's target of 2 to 3% inflation. Actually, 2 weeks ago, the Fed Chairman Jerome Powell, did mention that the disinflationary process has begun, and they're seeing it mostly in the goods sector. So, inputs to production. You mentioned lumber, which represents about 25% of the economy. Last month, inflation, came down again in Canada to 5.92% from 6.3% the month before. And I believe in the States, it was down from 6.5, a small change, to 6.4. So, that trend is reversed, and the trend has fallen. Keep in mind, we peaked in the mid 8s for inflation. But you're right that, the biggest wild card there, and again, we addressed that, the last time we met on this podcast, is wages. And the job market is stubbornly strong. And part of that, is a relatively strong economy, which is a good thing. Part of it's COVID related, a lot of people taken out of the workforce. The other thing that and this is maybe where we start to see that reverse a little bit, is, something I had overlooked is immigration. And both the United States and Canada for years has depended significantly on immigration to fill jobs in Canada and the United States. COVID shut the doors for immigration for 2 years. So we haven't seen that new movement of workers into North America to take jobs. And as the economy reopens, as immigration rules ease again, as we're seeing, I would expect that we have this new influx of foreign workers to fill some of these jobs. So again, if you have more supply of labor, you see a bit of a weakening economy where demand for labor falls. Simply, you see prices fall, or prices stop rising in the case of wages. So I do think, going back to your original question, Jay, probably a soft landing with inflation moderating, and the problem with inflation being wages starting to moderate as well.
Yeah, and you've seen that over the last little bit here. Hiring plans amongst CEOs has actually trended down. They expect a softer hiring process going forward. And even look at the unemployment data that we had a few weeks back. I think the U.S. had over 500,000 jobs in January. Canadian jobs added were over 100,000. And what that is, you're starting to see a transition from the white collar side of wages, and it's migrated into the blue collar side of things. So exactly to your point, Clark, I think you're going to start to see those wage inflationary pressures come down over the next 6, 12, 18 months.
Yeah, I think it's interesting just how stubborn the job market has been. And, it's hard to imagine inflation's rolled over, but it hasn't rolled over to the degree that obviously central banks would like it to have by this point in the wage hiking cycle. And it's hard to imagine more disinflation from here with the job market as strong as it is. And I think that's going to be the thing that we continue to contemplate going forward here over the next coming quarters and for the rest of the year. As employment is good, a strong economy is good, but at the same time we need a little bit of weakness just to see inflation ease off and hopefully give us a little bit of relief on interest rates to avoid more cracks in real estate and that sort of thing.
Well, that's certainly going back to Jerome Powell. That's what he's looking at. He keeps stressing the inflationary pressures you're seeing in the services sector, because you've seen durable and non-durable goods inflationary pressures come down, but the services sector, which is, I believe, is about 2/3 of the economy, is not coming down. So you need to start to see that before they'll ease their rhetoric, and this fear of higher interest rates from here start to abate. So I think we're still a month or 6 weeks off from the next Fed announcement. So between now and then, I expect probably the markets to digest these inflationary data that's coming in over the next little bit, and unemployment data that comes out the first week of March. And you're kind of seeing that within equity markets and fixed income markets. They've consolidated. We had a big, strong month, as you noted, Jay, for January. And February, you're kind of seeing things flatten out here a bit. We've digested a good gain, so it's not all. That's not a negative thing. It's time for a consolidation, and that's exactly what we've been seeing.
And when it comes to most of our clients' kind of investment plans, I think we can be a little bit naive to the quarter after quarter inflation readings, and I think more than anything, the last year has presented some compelling opportunities to do some buying, which we continue to do. And we will get through this kind of period of inflation, and that will kind of present the way for the next stage of the market here. So any closing comments, any thoughts on the SPY balloons or anything else going on out there that might impact clients' wealth plans?
One thing that we could talk about is some of these amazing series that you're seeing coming out on Netflix and Showtime and HBO and what have you. It's and I'm not a big TV watcher, but on the softer side of things, there's a new golf series out on Netflix, which is very interesting. I think you're starting to see some dramas on Showtime and HBO. So for those who find themselves maybe a little bit bored at night,
those who don't like talking about taxes with us.
Yeah, they sound a little bit lighter.
I read about inflation at night, Craig. I don't watch Netflix, so.
Okay, I think we'll leave it at that for episode 2 of the Plena Wealth Advisors podcast. Thanks for everyone again for tuning in and providing the feedback like you did last time. We look forward to doing this again, and until next time, we'll leave it at that.